Gold, oil, and copper once danced to the same global growth tune back in the early 2000s. Their prices all rose together as China led the emerging market world to higher commodity demand. Now, gold, copper, and oil are dancing to different drummers. Gold is focused on U.S. rate expectations and seems less interested in global growth and dissonance. Copper retains the moniker of Dr. Copper as a reliable metric by which to assess expectations of global growth during this trade war era. Oil has had to contend with a large dose of technological disruption from the shale oil boom, which led to rising U.S. exports, even as oil still responds to the ebbs and flows of global growth. Let us explain. With the trade war top of attention, the Fed having shifted to lower rates, and the shale boom in the U.S. continuing to be reflected in rising U.S. oil exports, gold, oil, and copper are all impacted differently. Oil supply has been disrupted by the U.S. shale oil revolution, such that OPEC has much less market influence than it once did. The result is that any rise in political tensions in the Middle East does not cause the price to rise as much as it would have a decade ago. The two big drivers for oil now are U.S. supply and global demand. The ebb and flow of the trade war is reflected in global oil demand expectations, which is overlaid on rising U.S. production. One commodity in the center of the trade war is copper. If the trade war weakens the Chinese economy and slows global growth, Dr. Copper will let us all know. Gold, interestingly, responds to the trade war through its impact on U.S. growth and then the Fed. The Fed cited future concerns that the trade war would slow global growth when it cut rates at the end of July. Indeed, gold's rise from $1,200 per ounce to $1,300 in the second half of 2018 was driven by the shift in expectations that the Fed would halt its relentless pursuit of higher rates. Then, in the summer of 2019, when the Fed shifted to cutting rates, gold made its move from $1,300 through $1,400. The escalation of the trade war in early August 2019 was associated with a decline in equities, a big rally in bonds, and expectations of even more rate cuts from the Fed. So gold powered up to over $1,500. The bottom line is that gold needs more rate cuts to go ever higher. Copper needs an end to the trade war and improved global growth expectations for it to rally. And for oil prices to rise, there could be either a trade deal or more tensions in the Strait of Hormuz. In short, copper, gold, oil are dancing to different drummers. They're not in tandem. The ebbs and flows of the trade war may drive them in opposite directions through the complex combination of shifts in global growth, expectations, and U.S. rates. I'm Blue Putnam, Chief Economist, CME Group.